Morning, listeners. This is Almus Market Mornings with Shikhar Garg. And folks, it's quite an interesting time to watch as how various tech developments are playing out. In something new, Fed have started tracking market sentiments with a new index built from millions of tweets. Basically, using a natural language processing technique, they try to identify the market sentiments around major events. It's quite a leap, I must say. But while such developments are taking place, there is still some development which are elusive and have kept the market confused and acting irrationally. It's the debt ceiling negotiations which have now resulted in a US T-bill auction for 21 days to yield above 6%. Now, that's quite an impressive interest rate for a 21-day T-bill. Dollar remains firm while the market cautions from this impasse. So, JK, I'd like to know more from you. What should we be expecting and what's going on in the market?
Hey, good morning, Shikhar. Yes, I think obviously the constant focus of the market is on the debt ceiling talks, which did give a positive indication on Monday and Tuesday. But since then, little progress has been reported about the talks, and that's what the market is slightly worried about because getting closer to the X date on June 1. This has been reflected in the yields and the stocks, and the yields are falling, and even stocks are getting hit on the base of this. Equities were lower across the market in US, and in fact, S&P 500 fell by 1.1%, with all the sectors reporting losses, excepting the energy sector, after Saudi energy minister fired a warning shot against the speculators ahead of OPEC Plus meeting. And we have, of course, had the European market also losing about 1%. But in Asia, risk of sentiment has taken further hit as news of China retaliating against the US by banning Micron, a US company, in retaliation to the US action last October by banning chip supplies to China. In fact, we had many other friendly nations of US also following suit and stopping chip supplies to China. Now, apart from this, reports also say that China is facing a new wave of COVID-19 infection that could see as many as 65 million cases per week by the end of June. So this type of news has actually resulted in the risk sentiment taking a hit. We are seeing markets down across Australia down 0.5%, China down 1%, Taiwan 0.5%. And after a stupendous rise of over 8% in the last 9 days, Japanese market has also slipped over 2% in the last 2 sessions. And now, as for the yields are concerned, they were little changed in the US session, but they have now been coming down in the Asian session in view of the risk of sentiment. Apart from that, the 2-year paper is commanding a good demand at the levels above 4.35 because the market is still looking at Fed cutting rates later in the year, and there is a bit of demand due to safe haven investment. Also, as you said, the T-bills maturing in June is commanding a yield of over 6.1%. But at the same time, we are also looking at a flight to quality from investors into AAA corporate short-term paper. And that is something which we haven't heard for a long time, and that has been happening. As I said, yields have dropped in Asia. 2-year has dropped by over 7 basis points. Now, as for the Fed rate hike expectations are concerned, we now have 40% odds of a 25 basis hike in June, although some of the members are also expressing that they can be this. It may be time to wait, not necessarily a peak in the rate, but maybe June meeting can be a wait or a pause. At the same time, the expectation of a rate cut in the year end has come down, steadily to now minus 34 BPs. At one point of time, at the peak of expectations, it was 3 rate cuts, then it dropped to 2 rate cuts of 0.25 each, and now it is down to only 34 basis points. As far as the dollar is concerned, it has maintained its midterm, which it got in the last 1 week. After rising through 103, the dollar index has stayed around that level, and helped by rising US yields. US data coming much better than expected. In the European numbers somewhat disappointing. The unresolved debt ceiling issue, as in here the X date, is also increasing the safe haven demand for dollars. Of course, going forward, I feel the dollar direction will depend on how the monetary policy evolves in the US. Technically, dollar has remained oversold for months, and with players carrying strong negative bias, but that bias seems to be getting reassessed. And looking at the divergent data and US rate expectations on a clear break of 103.70, dollar index is likely to test 105 levels. And on such a rise, we might see euro drop to even 1.05 at the extreme, and probably yen at 140 and the GBP at 1.21. Yesterday's data, just to give a brief glimpse, is that we had PMI flash surveys on major economies, which showed that it was a manufacturing sector which continued to contract across countries, but the services sector has been holding up very well. And the US was, once again, the best performer as far as both the sectors are concerned. Also, although the manufacturing sector there also is below 50, and we had one more evidence of manufacturing contraction in the US, which was following the regional surveys that had been coming up last few weeks. On the rupee, nothing much to say as far as the short-term moves are concerned, because we have had reports of offers from PSU banks at 85, and on even minor dips, the demand is quite persistent. And so it's being kept in a very strong, rather a very tight range. But there is some emerging news, from G7, which had, put together a comment to restrict trade and use of diamonds mined, processed, and produced in Russia, and that actually is something which a big impact on the Indian diamond industry as well as the employment related. And in fact, India, roughly accounts for 30% of the global rough demand, as Russia rather accounts for 30% of the global rough demand output, and this can be a big factor, going forward, because currently the demand for diamonds products are less, but as and when it picks up, it can have a bigger impact. And also news, or rather the RBI report shows that the net FDI flows in the year in FY23 was lower by 28 billion, apart from effect on the ECB flows, which got affected because of higher interest rates. Now the focus is on FOMC minutes tonight, which will be scoured for clues as to what the participants were thinking for the policy going forward. Now that we have some members thinking that June pause is okay, but then peak rate can be even 0.5% higher from where we are right now. So it's very interesting. It will be very interesting to see what kind of thoughts they have expressed in the minutes. We also had the Reserve Bank of New Zealand raising rates by 25 basis points today to its highest level in 14 years at 5.5%. But at the same time, while reiterating that inflation will remain high, they've also forecast a recession this year, and that's the reason why you have seen the New Zealand dollar coming off nearly 1%, because almost the central bank is saying that we are keen to rein in the inflation first at the cost of growth. So that's about the news in Asia. And yuan, in fact, we had seen it touch the previous high above on 7.07, and promptly there was some statement from Chinese state media saying that yuan unlikely to experience sharp volatility. So all in all, a kind of risk-off sentiment in the market, and dollar somewhat bid, a dollar rupee in a very tight range, and looking forward to more news in the coming days. Thank you.
Okay, JK, that was quite good. And yes, folks, a risk of sentiment in the Asian markets, majorly driven by the geopolitics and the debt ceiling impasse, is now acting up with the banning of American companies by the China and then new updates. But on the other hand, what we are seeing is the investors are now having a flight towards quality, and there's some sort of an quite distinct turn of events when it comes to rate expectations. And today's FOMC minutes may further influence the way market participants are expecting the rate hikes in the coming course of days, because it started off with 3 cuts, then it moved on to 2 cuts, and now it's further reducing the overall quantum of cuts that the market participants are expecting for the US. On the domestic front, the action was quite limited for the currency, but it was the globally the Reserve Bank of New Zealand which raised rates, on the contrary to majority of the central banks, which are now expected to have a pause. So there's quite a bit of mixed actionables that we are seeing from the market participants, and let's see how things go about in the coming days. That's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for listening.